Welcome to this explainer. If you really want to grasp how wealth is actually built without all the confusing Wall Street jargon, you are absolutely in the right place. Think about investing kind of like planting a mango tree. You don't just plant a seed and expect a giant basket of fruit the very next day, right? No, you nurture it, you let time do its thing, and eventually it becomes highly productive. Well, today we're exploring these super simple tools that let time and consistency do all that heavy lifting for your wealth.
Okay, let's dive into this. Here is our roadmap for today, which is going to demystify investing and prove it's really not just for the ultra-wealthy. We'll be hitting 1. The wealth creation shift. 2. Unpacking index funds and ETFs. 3. The magic of compounding. 4. Building your passive portfolio. And finally, 5. Mistakes you must avoid. Let's get started.
Section 1, the wealth creation shift. We really need to rethink how we earn. Because let's face it, just working harder isn't the only way to earn more. Your income alone has a hard ceiling of 24 hours in a day. This brings us to a really absolutely crucial distinction: saving versus investing. Now, you might be thinking these are kind of the same thing, but they serve completely different purposes. Saving, well, it's basically putting a protective shield around your money for future use, like an emergency fund. But here's the catch. While saving protects your money, inflation is quietly in the background eating away at that idle cash. Investing, on the other hand, puts your money on the offensive. It actually grows your cash to combat those rising costs. And this brilliantly illustrates the two totally different paths you face once you decide to invest: active or passive. Active investing is kind of that frantic movie version, trying to pick the winning stocks, perfectly time the market, beat everybody else. It is stressful. Passive investing, much calmer. Instead of trying to find the needle in the haystack, you literally just buy the entire haystack. You just aim to match the overall market, which completely removes the stress of picking winners. The ultimate goal of all this really boils down to acquiring assets. An asset is simply something that has the potential to generate income or increase in value over time. Basically, it puts money right into your pocket. So, the real secret to successful long-term wealth isn't just snagging a high salary, it's gradually accumulating more and more of these assets over your lifetime. Moving right along to Section 2, unpacking index funds and ETFs. Now we're going to break down the actual practical tools used by the world's most successful passive investors. We hear this buzzword thrown around constantly in financial circles, right? But it rarely gets explained in plain English. So what exactly is an index fund? I want you to picture walking into a massive, bustling fruit market in Lagos. It's crowded, it's loud, hundreds of vendors everywhere. Now, instead of spending hours agonizing over finding the single perfect fruit seller, you just buy a pre-made, mixed basket that has a little bit of fruit from all the different vendors. If a few fruits in that giant basket turn out bad, doesn't matter. The overall basket is still super valuable. That is literally exactly how an index fund works. It's the ultimate form of risk reduction. Formally, an index fund is an investment fund designed to passively replicate the performance of a specific market measurement, or index. Rather than paying some expensive Wall Street expert to guess which companies are going to win, the fund just buys the companies in the index. We owe a huge debt to John C. Bogle for this brilliant vision. He realized ordinary investors deserved a simple, low-cost way to participate in global market growth, and it completely changed the investing world forever. Let's move to and see how this builds into another incredible tool, the ETF, or Exchange Traded Fund. Both index mutual funds and ETFs give you that amazing market basket. But while mutual funds are priced and traded just once a day, ETFs are traded throughout the day on the stock exchange, exactly like individual stocks. They give you the amazing diversification of a mutual fund, plus the ultimate trading flexibility of a stock. But why choose these passive funds over paying a pro to actively manage things? Well, fees. Think of high fees as a really heavy backpack you're forced to wear while running a long race. An active fund might charge you, say, 1.5% a year, while a passive index fund might charge just 0.10%. Over decades, that heavy backpack of active fees violently drags down your returns. That is exactly why boring, low-fee index funds almost always win the race handily. Section 3, the magic of compounding. This is where we shift our focus to the real accelerator, the absolute wealth engine of passive investing: time. Albert Einstein is famously credited with calling compound interest the eighth wonder of the world. Now, whether he actually said this or not, the underlying math absolutely proves the point. Compounding is this incredible force where your money earns money, and then those new earnings go on to earn even more money.
It's a continuous, self-feeding loop of wealth creation. The absolute best way to visualize this is a snowball rolling down a really long hill. At the top, it's tiny, gathering snow pretty slowly. But as it rolls downhill, it gathers mass, and the larger it gets, the more snow it picks up with every single rotation, until the growth becomes totally exponential. Compounding works in curves, not straight lines. It takes profound patience for sure, because the most staggering, impressive gains happen in the later years of the journey. Consider two people. Investor A starts at age 25 and Investor B starts at age 35. Even if both of them invest the exact same $200 a month, Investor A is going to win massively. Why? Simply because of that extra 10 years for the snowball to roll. Time in the market is your ultimate advantage. You literally cannot buy past time, which is exactly why starting right now is so absolutely critical. Section 4. Building your passive portfolio. So the crucial point is moving from all this theory to immediate actionable steps you can actually take today. Here is your compressed roadmap. And remember, simplicity, not complexity, is the goal of a great portfolio. 1, define your goals so you have a target. 2, build an emergency fund so you never panic sell. 3, choose those broad core investments. 4, set your asset allocation, like how much in stocks versus bonds. 5, invest consistently every single month. And 6, rebalance periodically as your assets grow. See, it's really that straightforward. An actual diversified beginner portfolio doesn't need to be 50 confusing things. It can be as simple as 60% in a broad market index for aggressive growth, 20% in an international index to capture global economies, and 20% in a bond fund to give you stability when the stock market gets bumpy. You balance aggressive growth with peace of mind. Now, you might be thinking, I don't have thousands of dollars to start. But imagine starting with just $50. A university student in Accra, or maybe a young professional in Nairobi, investing just $50 a month consistently. Over 20 or 30 years, that small, regular action, combined with the growth of the global market, produces remarkable, life-changing wealth. And the safety net holding this all together is diversification, spreading your investments across different assets, industries, and countries to reduce the impact of any single business failing. It's the ultimate golden rule. Never, ever put all your eggs in one basket. By owning the whole market, it protects you from those company-specific risks wiping out your hard-earned money. Finally, Section 5, mistakes you must avoid. Successful investing is honestly just as much about managing your own behavior as it is about picking funds. We need to be fully aware of the behavioral pitfalls that destroy wealth, trying to get rich quickly by chasing hype, attempting to time the market by guessing highs and lows, panicking and selling everything during a crash, and completely ignoring those high management fees we talked about. Honestly, fear and greed are the two absolute biggest enemies of long-term compounding. Now, what's really interesting about this slide is this profound truth. Consistent investing, even right through terrifying market crashes, will always outperform sitting on the sidelines waiting for perfect economic conditions. Doing the boring, consistent thing, buying a little bit every month, a strategy called dollar cost averaging, beats trying to be a financial genius every single time. We've covered the tools, the mindset, the math, the whole shebang. But knowledge without execution, well, it's just trivia. The best time to plant that mango tree, the best time to start investing, was years ago. But the second best time? That is today. So I leave you with this question. You have the map. What is your very first consistent action going to be today? Thanks for joining me on this explainer, and here's to building your simple path to wealth.